Let's talk about some positive economic signs we're seeing for the housing sector. Hi, I'm Beata Bukowski with Fairway Independent Mortgage, coming to you with our weekly economic update. The biggest of those good news is the inflation cooled in December for the sixth consecutive month. And that's a key signal for the Fed to potentially slow down on their next moves on the Fed fund rate. No matter what the Fed does at the next meeting, the bottom line is that mortgage interest rates are over 1% lower off their highs in the mid-sevens back in October. The Mortgage Bankers Association is predicting mortgage interest rates to end this year in the low fives, whereas Logan Mahtashami, the chief economist for Housing Wire publication, is even more optimistic, talking about dipping even below 5%. On that, inflationary numbers, consumer price index came out for December. It showed a drop from 7.1 to a 6.5% on year over year, and the core, which removes the most volatile food and energy prices, dropped from 6% to 5.7%. As we know, inflation is the arch enemy of mortgage-backed securities and therefore mortgage interest rates. Therefore, anytime we see inflation dropping, it will have a positive effect on mortgage interest rates, as seen already. Inflation remains to be the top of mind for all small businesses. The National Federation of Independent Business Owners Optimism Index has dropped again and is weakest since 2013. The biggest, again, contributor to it is their concern for inflation. As far as employment market, we have 1.634 million people collecting unemployment as continuing claims. One other thing worth sharing with you as far as last week is just an observation that we are pointed at definitely a slowdown and recessionary measures. The yield spread between the 10-year bond and the 3-month Treasury bill has inverted almost 120 basis points, 1.2%. Typically, you would think that when you're investing into a longer-term bond, you would get a higher yield than on the 3-month. And it's so inverted that it's over 1% difference. That is one of those very strong indicators for recession coming. That's all I had for you today. Beata Bukowski, over and out.